Welcome to our deep dive into quantitative analysis for long-term stock selection. Going beyond traditional fundamentals, if you're looking to build wealth through stocks, this video is for you. We'll explore how quantitative methods can help you pick winning stocks for the long haul. Let's start with the basics. What is quantitative analysis? Quantitative analysis uses mathematical models and data to make investment decisions. Unlike fundamental analysis, which looks at a company's financial health, quantitative methods focus on numbers and patterns. Think of it as a data-driven approach to finding stocks with the best potential. Why go beyond fundamentals? Fundamentals like revenue, profit, and debt are critical, but they don't tell the whole story. Quantitative analysis digs deeper, using metrics that capture market behavior, volatility, and trends. In 2025, with markets more complex than ever, this approach is gaining traction. Let's break down why quantitative analysis is so powerful for long-term stock selection. First, it removes emotion from investing. Humans are prone to bias, like chasing hot stocks or panicking during dips. Quantitative models stick to data, ensuring decisions are objective. Second, it processes vast amounts of data quickly, something no human could do. From stock prices to economic indicators, quantitative tools analyze it all in seconds. For example, a stock's price momentum or volatility can signal future performance. Now let's look at the key quantitative factors for long-term stock selection. One popular factor is the quality factor, which identifies companies with strong fundamentals. This includes high return on equity, low debt, and stable earnings. Studies show quality stocks tend to outperform over time, especially in volatile markets. Another factor is momentum, which looks at stocks with strong recent price performance. Momentum stocks often continue to rise in the short to medium term. For long-term investors, combining momentum with quality can reduce risk. Volatility is another key metric. Low volatility stocks are less sensitive to market swings. These stocks may not skyrocket, but they offer stability for long-term portfolios. Value factors like low price-to-earnings ratios also play a role. Value stocks are often undervalued and have room to grow as the market recognizes their worth. In 2025, value stocks are gaining attention as growth stocks face valuation concerns. Let's talk about how to apply these factors using quantitative models. A common approach is factor investing, where you select stocks based on specific traits. For example, a model might rank stocks by quality, momentum, and low volatility. The highest-ranked stocks are then added to your portfolio. This systematic approach reduces guesswork and ensures consistency. Another method is multi-factor models, which combine several factors for better diversification. By blending quality, value, and momentum, you can balance risk and reward. Research from 2024 shows multi-factor models outperform single-factor strategies over time. Now, let's explore how technology is revolutionizing quantitative analysis. Artificial intelligence and machine learning are game changers for stock selection. AI can analyze massive datasets, from stock prices to social media sentiment. For instance, natural language processing can scan earnings calls to gauge management confidence. This gives investors an edge in predicting stock performance. Machine learning models like neural networks can also predict stock price trends. A 2020 study showed that LSTM neural networks improved stock prediction accuracy. These models learn from historical data to spot patterns humans might overlook. In 2025, AI-driven quantitative strategies are becoming more accessible to retail investors. Platforms like TradeStation and interactive brokers offer tools to build custom models. But AI isn't perfect. Overfitting where models rely too heavily on past data is a risk. To avoid this, stress test your models against extreme market scenarios. Let's discuss some real-world applications of quantitative analysis. Take NVIDIA, a stock that's been a focal point in 2025. NVIDIA dominance in AI chips has driven its stock price to new highs. Quantitative models might flag NVIDIA for its strong momentum and growth metrics. However, high volatility and tariff concerns could lower its ranking in a multi-factor model. This shows how quantitative analysis balances opportunity with risk. Another example is small-cap stocks, which are undervalued in 2025. Morningstar reports small caps trade at an 18% discount to fair value. Quantitative models can identify small caps with strong quality and value scores. These stocks may outperform as the economy stabilizes. Now, let's address the current market environment in April 2025. The S&P 500 has faced a correction, down over 10% from its peak. Tariffs announced in April have sparked volatility, especially in small caps. Quantitative models can help navigate this by focusing on low volatility stocks. They can also identify sectors like financials, which outperformed in 2024. Let's dive into building your own quantitative strategy. Step 1. Define your factors. Choose metrics like quality, value, or momentum. Step 2. Gather data. Use platforms like Yahoo Finance or Bloomberg for stock metrics. Step 3. Build a model. Simple spreadsheets or Python can rank stocks based on your factors. Step 4. Backtest your model. Check how it would have performed over the past decade. Step 5. Implement and monitor. Adjust your model as market conditions change. For beginners, start with a simple two-factor model like quality and value. This keeps things manageable while still delivering solid results. Let's look at some challenges of quantitative analysis. Data quality is critical. Inaccurate or incomplete data can skew your model. Market conditions also change. A model that worked in 2020 may fail in 2025. Regularly update your data and test your model's performance. Another challenge is overcomplicating your model. More factors don't always mean better results. Keep it simple and focus on factors with proven long-term success. Let's wrap up with some tips for success in 2025. First, diversify your portfolio. Don't rely on a single factor or sector. Second, stay disciplined. Stick to your model even during market turbulence. Third, keep learning. The more you understand quantitative methods, the better your result. Finally, consider blending quantitative and fundamental analysis. Use quantitative models to narrow your choices, then dig into fundamentals for final decisions. This hybrid approach can maximize your chances of picking winning stocks. Quantitative analysis is a powerful tool for long-term stock selection. By focusing on data, you can uncover opportunities others might miss. In 2025, with markets facing uncertainty, this approach is more relevant than ever. Start small, experiment with simple models, and grow your skills over time. Thanks for watching. If you found this helpful, like and subscribe for more investing tips.